Hello friends, today we'll be discussing the topic money supply, the measures of money supply and the determinants of money supply. Moving on to the money supply. Money supply refers to the stock of money held by the public at a particular point of time as means of payment and store of value. When we talk about money supply, it includes only that part of money which is actively involved in the economic activities. So we don't include that money which is lying idle as reserves somewhere which is not involved in the economic activities. Hence we emphasize over here the money held by the public, and it is a stock concept, not a flow concept, because we measure money supply at a particular point of time. Coming to the components of money supply, it includes two components, currency component and deposit component. Currency component is nothing but the coins and currency notes issued by the central government, which is also known as the legal tender. And when we talk about deposit component, it has demand deposits and time deposits. Demand deposits refers to those deposits which a customer is willing to withdraw at his own will and wish, whereas time deposits are deposits which are withdrawn after completion of maturity period. Hence, savings deposits and current account deposits are called as demand deposits, whereas time deposits, examples are fixed and recurring deposits. Traditionally, demand deposits can also be classified into other two categories, primary deposits and secondary deposits. Primary deposits are those which a customer goes to a bank and opens by themselves for the purpose of saving money, for the purpose of earning interest, whereas secondary deposits are the deposits which bank opens for the customers in order to provide loans. So when we talk about process of credit creation is nothing but expansion of secondary deposits, which further leads to increase of money supply. When we talk about money supply has been differently explained by different schools of economists. Firstly being the classical approach. Classical approach says money supply is currency and coins plus demand deposits. So they mainly focus on one function of money, that is being medium of exchange. Whereas Chicago School of Economists or the Friedman's view emphasizes that money supply should be taken in a broader way and also should include store of value function of money. Hence, according to them, money supply is CC plus DD plus TD, that is currency and coins plus demand deposits plus term deposit. Gourlay and Shaw moves a step ahead and says that importance should be given to the non-banking financial sectors. Hence, they include the liabilities of non-banking financial institutions in money supply. And when we come to Redcliffe's approach, according to them, unorganized sector generate good amount of credit which leads to strengthening up of economic activities. Hence, according to them, money supply should not just include currency and coins, term deposits, demand deposits, liabilities of non-banking financial institutions, but also should include the credit circulated by unorganized sector. Coming to the RBI approach, which we are presently using. Measures of money supply. When we talk about measures of money supply in India, RBI has been playing an active role of constantly devising new measures of money supply. The first method was given in 1966, which was revised in 1979, and the next method was given during 1998 under the supervision of Dr. Y.V. Reddy. Let's look the old method. It includes four measures: M1, M2, M3 and M4. M1 is CC plus DD plus other deposits with RBI. CC refers to currency and coins, DD refers to demand deposits. Now what are other deposits? Other deposits are the demand deposits made by the public institutions like IDBI, SIDBI, and also by the foreign central banks and international financial institutions. The second one being M2, which is nothing but M1 plus SD, that is savings deposits of post office savings banks. M3 is M1 plus TD, that is term deposits with commercial bank. M4 is a much more comprehensive concept as it includes M3 plus TPOD, that is total post office deposits. When we talk about new method includes three measures: NM1, NM2 and NM3. M4 is not considered in the new method. NM1 is same as M1 in the previous method, whereas NM2 has undergone certain changes. NM2 is NM1 plus short-term deposits up to 1 year. NM3 is NM2 plus long-term deposits beyond 1 year plus call term fundings from the financial institutions. Hence, in the new method, we don't find M4. We just have NM1, NM2 and NM3. They have also come up with the liquidity aggregates as L1, L2 and L3. Now, most prominent question that students face is narrow and a broad money. What is narrow money? M1 or NM1 is called as a narrow money as it focuses on the major function, that is medium of exchange of money, only on one function. But when it comes to broad money, M3 and NM3 is called as broad money as it not only focuses on medium of exchange function of money but also emphasizes on the other function, that is store of value. Hence, in broad money we include term deposits which referred to as the store of value of money, which performs the function of money as store of value. Moving on further to the next concept, that is high powered money, which is popularly known as monetary base or M0. This concept came into popularity after the suggestions given by Dr. Y.B. Reddy to the RBI during 1998, and M0 is nothing but currency in circulation plus currency deposits of commercial bank with RBI, that is the reserves maintained by commercial bank with RBI. Now this base money or this high powered money is very crucial to improve the money supply in the economy. Determinants of money supply. When we talk about determinants of money supply, the size of monetary base is a very crucial phenomena here. The size of monetary base is higher is the money supply. But if the monetary base in the country is less, the supply of money is also lower. But monetary base is influenced by two other factors, one being the gold stock with the central bank and the reserve assets including debentures, treasury bills with the central bank. So, if the central bank, if the country strengthens the monetary base, the money supply also tends to be higher. Coming to the proportion of cash and demand deposits, if the people hold more cash with themselves and less cash at bank, then the deposit ratio is less for the credit creation process contracts, which also leads to fall in money supply. But if people hold more cash at bank and not at hand, then the credit creation process strengthens, which increases the money supply. The third one being required reserve ratio. Every commercial bank has to maintain a particular reserve and then further circulate the rest deposit amount in form of loan. This is called as the fractional reserve banking system. Hence, if the required reserve ratio is less, the money supply is high. But how is that so? Let's see an example. If a bank has 1000 crores as total deposit, out of which the bank has been advised by the central bank to maintain 10% as the reserves. So the bank keeps 100 crores as the reserves and 900 crores is circulated as loans. But if the same central bank advises the bank to keep 40% as reserves, then it would maintain 400 crores as reserves and 600 crores would be circulated as loans. So there is a good amount of contraction in the amount of loan generated by the commercial banks, which leads to fall in money supply. Moving on further to velocity of money circulation, it refers to the unit of money, how many times does it change the hand, that is how many times a unit of money changes the hand. It depends upon the propensity to consume, the amount of cash transactions taking place in the economy. It also depends upon the type of developed or underdeveloped banking system in the economy. Higher the velocity of money circulation, higher is the money supply. The last factor, that is money multiplier. Money multiplier explains to us the ratio of change that takes place in money supply due to change in monetary base. Hence, higher the value of money multiplier, higher is the money supply. Thank you. I hope the video was helpful to you all. If so, kindly like, share and subscribe to our channel Puru's EduLogic, and please provide your valuable feedbacks for further improvisation. Thank you. Signing off.